Hello, everyone, and welcome to the NinjaTrader webinar room. This is Wesley Sinks joining you today from the NinjaTrader ecosystem. Before I begin, I would like to do a quick test of picture and sound, so if you could please just type a Y in the room to confirm you can hear my voice and see the slideshow on screen. All right, thank you for that confirmation. Again, thank you all for spending time with NinjaTrader today. We do have a very special event for you today. We have mentor Mike Bridges of Pacific Trading Academy ready to give you a wonderful presentation. NinjaTrader ecosystem is pleased to sponsor these weekly partner events as a value-added service for our clients. These events are intended to provide increased exposure to the various trading styles and methods taught by our partners. So if you do find value in these events, we hope that you will attend them on a regular basis. Also, feel free to stick around after today's event. You can learn more about using NinjaTrader charts and trading directly from your chart with ChartTrader. That event's going to start at 12 noon Eastern Time today. Now, real quickly, I'd like to ask everyone in the room a question. If you could, please choose the 1, 2, 3, or 4 on this poll screen. That will give me an idea of who we have joining us today. And real quickly here, while you fill that poll out, just wanted to mention here real quickly that it is important to understand there are substantial risks in trading commodity futures contracts. You should carefully consider whether such trading is suitable for you. That will depend on your specific circumstance and financial resources. It is possible to lose all funds deposited with your broker, and you could even incur losses beyond these amounts. Please inquire at brokerage support at ninjatrader.com for more information or for a copy of the CFTC full risk disclosure. Also, please remember that these ecosystem webinars are not a solicitation or recommendation, but simply educational in nature. All right, it looks like most of you had a chance to fill that poll out. Looks like in the lead we do have those of you using the free license of NinjaTrader. I also do see quite a few of you leasing NinjaTrader. And I don't see any here in the room that have not yet used NinjaTrader, but if you have not already done so, you can download NinjaTrader from the following link. All right, and give me just a moment here. I'm going to get Mike's slideshow pulled up. All right, if you are one of those in attendance who has not yet used NinjaTrader, as I said, you can download NinjaTrader from that link I just placed into the room. You can get started with simulated trading, advanced charting, market analytics, and strategy development. This free version of NinjaTrader that can be downloaded from that link has no expiration date, so you can use it for as long as you like. All right, again, we're very excited for this unique event with Mike Bridges, whose topic for today is Mentor Mike's Elliott Wave More Essentials. Please join Mike for an exciting event covering the advantages of Pacific Trading Academy. I'd like to thank you all again for your attendance today, and without further ado, it is my pleasure to welcome to the NinjaTrader webinar room Mentor Pacific Trading Academy. Go ahead and take it away, Mike.
Okay, Wesley, thank you very much for that introduction. And I am Mentor Mike Bridges with Pacific Trading Academy here in Los Angeles, California. And today I hope that I can give you something of value with regard to Elliott Wave theory. So let's get started. But before we begin with our topic, for those of you who don't already know me, permit me to introduce myself briefly. I am a California lawyer, largely retired now, but I specialize in financial planning. I've held a number of FINRA licenses, Series 3, Commodity Futures and Options, Series 7, General Securities, Series 66, Investment Advisor. I've also held some California insurance licenses in life, accident, health, and variable contracts. But the thing I've enjoyed doing for most of my adult life has been to trade and learn about the markets and teach others about the markets. I've actually been trading since 1984, that's 30 years ago, and I've been mentoring others in stocks, futures, and Forex since 2000. That's for 14 years. I've been an NFA CFTC registered commodity trading advisor since 2003. My favorite method in market is to day trade the S&P E-mini, and our examples and charts today are going to come from that market. My favorite platform, of course, is NinjaTrader 7. I have been a satisfied customer of NinjaTrader since 2009. My favorite broker for the S&P E-mini is Trenton Kimino of Global Futures and Encino. But as many of you probably know, NinjaTrader now has its own brokerage firm, and I'm in the process of opening an account there. I don't have any specific personal experiences to relate, but I'm sure if they conduct their brokerage business as professionally as they have their software, we can look forward to a long and mutually profitable relationship there. This is my public profile on LinkedIn. This is my one concession to social media. If any of you are also members of LinkedIn and have not connected with me already, please invite me to join your network, and I will be happy to accept that invitation. I post almost daily on my profile various things regarding my personal trading and the trading in my live trading room and so forth, so it's a good way for us to kind of stay in touch. Also, I have a regular blog page on the Pacific Trading Academy website, and this webinar, in addition to being recorded and put on the Ninja Trader YouTube channel, will also be available on the Pacific Trading Academy website, and specifically my blog page. And the way you get there is pacifictradingacademy.com. You want to go to the blog link and then select Mentor Mike's Market Movie. Now, let's begin. How do you eat an elephant? Why am I starting with this old riddle? Well, the answer, of course, is one bite at a time, and I think that this is a great way to approach just about any challenging thing that we face in our lives, including learning how to trade. Any large task can seem overwhelmingly difficult at the outset. The key is to break it down into manageable chunks and then just get started. We can apply this proven technique when attempting to make sense of the chaotic motion on a price chart. And another fellow who I think used this technique is this guy here, Ralph Nelson Elliott. Now you can see his dates, 1871 to 1948. In the early 1930s, right after the big initial stock market crash in 1929, Elliott began his systematic study of 75 years of stock market data, which included index charts, and there were increments ranging from yearly to half-hourly. And it was in August of 1938 that he detailed the results of his studies in his book entitled The Wave Principle. Elliott stated that while stock market prices may appear random and unpredictable, they actually follow predictable natural laws and can be measured and forecast using Fibonacci numbers. Now, I want to show you some free resources on the internet that will assist you in learning more about Elliott Wave. This is a screen capture of the home page of a website called ElliottWave.com. It is owned and operated by a gentleman named Robert Prechter, who, in the opinion of many, is sort of the greatest living guru of all things having to do with Elliott Wave. But you can see we have some links here, education and free resources. And there's a store where you can buy various books and tapes and things like that. But you can actually learn quite a bit from the free resources. And I'm a big fan of free education when it comes to trading, as obviously you are too, because you're here at this webinar. Now, in addition to ElliottWave.com, Mr. Prechter has another website, and that's this one here, Socionomics.net. Now, that's a pretty highfalutin title. What does it mean exactly? Well, socionomics, sounds like an amalgam of sociology and economics, and I'm sure that that's what Mr. Prechter was going for. But here's what it's about. He has a position, and this is actually echoing the original position of Elliott himself, that the Elliott wave pattern, the 5-wave impulse followed by the 3-wave correction, is not just found in the stock market, nor is it just found in financial markets at large, but is actually found throughout nature in any kind of endeavor where you've got large numbers of people interacting. This can include things like, our propensity for making war on our neighbors, to the type of cinematic entertainment that is turned out by Hollywood, to ladies' fashions ranging from the risque to the conservative, etc. Now, On this website, if you go to the basics link, you can learn a lot about the socionomics theory, and obviously you have to know something about Elliott wave to appreciate socionomics, so they go into some detail there. But one of the best features of this website, and one that I refer to all my students, is this link here, which goes to an hour-long video called History's Hidden Engine. It's totally free. I think it has chapter headings, so you can watch it over a period of time. You don't have to watch it all at once. It's about an hour-long video, and it's really well done. It reminds me of something that you might see on, the History Channel or the Discovery Channel, and it basically lays out this socionomics theory. But as stated previously, in order to understand it, you got to know a little bit about Elliott wave. So they go into Elliott wave. And of course, Elliott wave is largely based on Fibonacci numbers and ratios, so they go into that as well. So I know for myself personally, I learn very well from video. There's something about the combination of the visual stimulation of the imagery along with the auditory stimulation of the soundtrack that really sinks into my brain in a very effortless way. So if you are at all like that, you will find that this is a great way to get refreshed or introduced to Elliott wave with very little effort on your part, and you may even find it entertaining. Now, this is a scan of the front and back covers of a great little pamphlet. It's only about 40 pages long, called The Basics of the Elliott Wave Principle. And it comes from Mr. Prechter's Elliott Wave International. And here's the inside covers, and as you can see, Elliott Wave International is in Gainesville, Georgia, and there's some numbers there for you. I'm sure you can get the details about how to contact Elliott Wave International from the elliottwave.com website that I showed you earlier. And I can't remember whether I purchased this by itself or whether it came with some other item that I bought in the past. But it's a great little concise way of getting the rules and guidelines of Elliott wave all in one place. So if you get a chance, you might want to check into that. Now, I'm going to tell you a lot about what you need to know on the subject of Elliott wave. By the way, I did a previous webinar on Elliott wave called Just the Essentials. Today we're talking about more essentials. And I did that back on April 19th of this year, I believe. So you can find that on my blog page on the Pacific Trading website that I showed you earlier. We're going to cover some of the same material there, and we're going to cover some new material as well. But first of all, if you're going to talk about Elliott waves, you got to know the wave types. There's essentially two basic patterns: motive patterns and corrective patterns. Motive patterns move in the direction of the trend on the next higher time frame. They are constructed of 5 waves, and there's 2 kinds: impulse and diagonal triangle. Motive patterns are relatively easy to recognize. Now, impulse is your basic 5-wave pattern, 1, 2, 3, 4, 5. The diagonal triangle is found most frequently in a wave 5 position, and I won't say it's fairly rare, but you don't see them all that much. Now, corrective patterns. Corrective patterns are at the same time the most difficult to learn, but they're also the most important. They move against the direction of the trend on the next higher time frame, and there's 4 main categories: zigzags, flats, horizontal triangles, and combinations. But there's also, unfortunately, numerous subtypes. Simple corrective patterns have 3 waves. Complex versions can have 13 or more waves. And if you find yourself trying to do a wave count and you don't have a clue what's going on, then you're probably looking at a corrective pattern. By the way, with respect to questions, I'm not going to have time to interrupt the presentation for questions along the way. If we have time at the end, I will cover as many as I possibly can, and I'm also going to give you my personal email, so any questions that don't get answered, you can send to me, and I will respond to you directly. So we've got motive patterns and corrective patterns. We also have Fractals and Fibonacci's. Two important aspects of Elliott wave is that Leonardo Fibonacci and his sequence of numbers and the various ratios that you can derive from them is found throughout Elliott wave theory. Mr. Elliott was a big fan of Fibonacci, and so it's no big surprise that we have, 5 impulse waves, 3 corrective waves. Those are all Fibonacci numbers. Now, fractals you may not be as familiar with. Fractal is a term that was actually coined in the 1970s, but Elliott described perfectly what they involve. Fractal geometry refers to a pattern that is made up of smaller versions of itself, and then at the same time it's part of a larger similar pattern on a higher time frame. Now, this little drawing over here at the left I actually made myself many years ago, and it is designed to represent 3 different levels or time frames of an Elliott wave pattern. So look first, if you will, at the black lines. We have the basic 5-wave impulse pattern, 1, 2, 3, 4, 5, followed by a typical 3-wave zigzag correction, A, B, C. Now look at the red line. The red line shows you that within each of these black-colored waves, we actually have entire patterns. Every one of the motive waves, 1, 3, and 5, actually has an entire 5-wave pattern within it, and the corrective waves typically have a 3-wave pattern within them. So we have knocked it down to a lower time frame, and in turn, this black pattern with the impulse wave and the corrective wave might very well be waves 1 and 2 on a higher time frame. So this is the actual nature of the market. This is not speculative theory. You don't have to look at very many charts to be convinced that this is indeed how the market is created. So fractals and Fibonacci have a lot to do with Elliott wave. Notice also I have here these 2 primary Fibonacci ratios, 61.8 and 38.2. Now, as you Fibonacci fans already know, if you take any number in the Fibonacci sequence, it will tend to be about 61.8% of the number that comes immediately after it in the sequence, and it will tend to be about 38.2% of the number that comes after it in the sequence. So there's a number of ways that you can slice it, but these are the 2 primary ratios. Now, let's talk about the Elliott wave rules. There really aren't that many. In fact, in my humble opinion, there are just these 3. Wave 2 cannot retrace more than 100% of wave 1. Okay? Wave 4 cannot retrace more than 100% of wave 3. And finally, wave 3 cannot be the shortest motive wave. Now, waves 1, 3, and 5 are the motive waves. They're the ones that move in the direction of the trend on the higher time frame. Wave 3 must be longer than either 1 or 5, but it doesn't necessarily need to be longer than both. In other words, the rule isn't that 3 is the longest, it just cannot be the shortest. Now, frequently, in fact, it is the longest, but you can get into trouble if you don't fully understand the nature of the rule. Now, there's another one that you may have heard of, and that's this one here. Some source material says wave 4 cannot enter the price territory of wave 1, but this is not a universal rule. Now, the quote below is taken from Bob Prechter's book, and I want to read it to you because this is the definitive word on this particular rule or non-rule, depending on how you look at it. This rule holds for all non-leveraged cash markets. Futures markets, with their extreme leverage, can induce short-term price extremes that would not occur in cash markets. Even so, overlapping is usually confined to daily and intraday price fluctuations, and even then is rare. Well, what he's saying is this rule really only applies in cash markets that are on a time frame higher than daily and definitely higher than intraday. Well, I am a day trader of the S&P E-mini. The S&P E-mini is a futures, and it's definitely intraday. So according to Mr. Prechter, the expert, I can expect a certain degree of overlapping between wave 4 and wave 1. Now, the other thing I want to mention in support of Mr. Prechter here is this quote came from his book that was published in 1978. That's nearly 20 years before the advent of electronic trading. And so there wasn't a lot of available data for intraday trading of futures at that time. So he, did a great job of reiterating Elliott's original writings, given what he had to work with. But my experience has been that you can get an overlap of wave 4 and wave 1 in an intraday futures market. So it is not the universal rule that many of you may have come to believe. Now, in addition to the rules, there are some guidelines. What are they exactly? Well, Prechter refers to them as typical yet not inevitable characteristics. And the ones that I follow are extension, alternation, channeling, ratio relationships, and truncation. Extension. The motive waves, that is 1, 3, and 5, can sometimes appear noticeably longer and have more prominent subwaves. In fact, these subwaves can sometimes rival the size of the waves in the primary pattern. Now, any of the motive waves can be extended, and sometimes even more than one. But wave 3 extends the majority of the time. Wave 3 tends to be the biggest. It's never the smallest, and it's probably the one that is going to be extended more than the other two, but not exclusively. Alternation. This refers to the corrective waves, which are 2 and 4. If one of the corrective waves is a simple zigzag, the other one will tend to be a more complex form and with more prominent subwaves. And as with extensions, these subwaves can sometimes rival the size of the waves in the primary pattern. Now, in my experience, wave 4 is more often the complex one, but in this particular example that you see here, it's actually wave 2 that is the complex one. And we'll have a chance to look at this particular Elliott wave pattern in greater detail in just a moment. Now, we also have the guideline of channeling. What that means is that an Elliott wave pattern, both motive and corrective waves, will tend to fit within a regression channel drawn between the pattern's starting and ending points. Now, what is a regression channel? Well, it's a drawing tool, and of course, NinjaTrader's suite of drawing tools includes the regression channel. And how it works basically is this. You typically draw it from the start of the pattern to the end of the pattern, and it contains 3 lines. In the version you see here, this magenta colored line is the what I would call kind of a self-correcting moving average, and then there's 2 sort of lime green lines, one above and one below that magenta line. And what happens is, as you draw the channel from start to finish, the center line, the magenta line, adjusts itself as it goes along so that it's always positioned in sort of the mathematical center of the price range between highest highs and lowest lows. And then the channel lines, the green lines, are a certain number of standard deviations above and below that regression channel line. Now, standard deviation is a statistical measurement that basically says that in any sampling, the bulk of the data is going to fall in the middle, and you're going to get less and less of it as you go out to the sides. The bell curve is a classic example of standard deviations. But in any event, what this channeling guideline refers to is that when you draw the regression channel over the entire pattern, we find that the bulk of the pattern by far fits within the channel. And when the price decidedly breaks out of the channel, it signals that the original pattern has now completed and a new pattern in the opposite direction is beginning. And again, we'll have a chance to see this up close in just a moment. Now, how about ratio relationships? Well, Elliott wave theory is built upon Fibonacci numbers and ratios, as I mentioned. So, for example, we have 5 wave motive patterns and 3 wave corrective patterns, and of course 5 and 3 are both Fibonacci numbers. If we consider the entire length of a 5-wave motive pattern to be 100%, we'll frequently find that the distance from the start of wave 1 through the end of wave 3 is about 61.8% of the total. And then wave 5 makes up the remaining 38.2% of the complete pattern's length. Now, this is not universal. This is frequently found. There's other Fibonacci ratios that are sometimes included here, but the 61.8 and the 38.2 are the two biggies, and those are the ones you're going to see the most probably. Now, truncation. Truncation refers to the fact that on occasion, wave 5 may not exceed the end of wave 3. Now, in this small chart here, you can see we have what appears to be a bearish pattern, and it looks like this is wave 3, 4, and 5, and 5 is a little bit shorter than 3. It doesn't come all the way down here and end at a longer level below. Now, I know that truncation is a real phenomenon, and I believe it can happen, but I also think it's fairly rare. I said extremely here. That might be a little bit too strong of an adverb. It is rare, however, and so when I encounter a situation where it appears we have a truncated wave 5, I will look very carefully to make sure that there's not another possible wave count that doesn't require the use of truncation, and oftentimes I'll find that that's the case. But if there's no other wave count that is viable in terms of not breaking any rules or running afoul of any guidelines, then truncation is a real thing. Now, here's some wave counting tips that you can use in your endeavor to learn how to spot Elliott wave patterns and know where you are within them. First of all, you want to practice your wave counting after the pattern is fully completed. Eventually, of course, you're going to want to make some predictions based on the pattern as it's unfolding. But when you're in learning mode, you need to wait until the pattern is fully completed, because you have to know what the Elliott wave patterns look like in their finished form before you can ever know what they're going to look like while the pattern is still in the process of forming. The technique I use involves starting at the ends and working towards the middle. Now, it's been my experience that based on the fact that wave 3 is the most likely of the motive waves to be extended, I generally assume that the first zigzag is probably waves 1 and 2. And I likewise assume that the last zigzag is probably waves 4 and 5. And everything in between is probably wave 3 and its various subwaves. Now, I recommend that if you're using my chart template with the red, white, and blue motif and my red parabolic SAR, use the momentum modules that are created by the red parabolic SAR whenever possible, and you'll see what I'm talking about in just a second. Once you think you've got a wave count that works, you can kind of test it out with the channeling and ratio relationships. And any wave count that does not break a rule or grossly violate a guideline is potentially the correct wave count. Now, notice I said the correct wave count. It should really be a correct wave count, because Prechter acknowledges that under certain circumstances you can have a situation where there could be more than one wave count that is potentially viable. In other words, it doesn't violate any rules and it doesn't run afoul of any guidelines. And so oftentimes it's the case that there could be more than one. that works, and so simply be aware of that. There's also going to be cases, however, where you're going to have a situation where you have two potential wave counts, but only one of them can be the real one, but you're not going to know which is which until the market moves on a little further and gives you additional information. The good news about that, however, is that once you know which it is, you can sometimes, kind of load the boat and really go forward with an extra high degree of confidence. All right, let's see how this works in some actual practice. Now, here is a nice bearish pattern, and many of you who are familiar with my technique know that I use a trend-defining moving average. It's a moving average of a specific length. It's a Fibonacci number, and I have found that every Elliott wave pattern begins on one side and ends on the other side. And so in keeping with my tips that I just gave you, chances are that the first drop across the trend definer and the first wave here is going to be wave number 1. And of course, the lowest low of this apparent pattern is going to be wave number 5. Now, normally, I would expect that I'd be looking at this pattern after the price had crossed the trend definer and probably flipped the big parabolic to confirm that this was indeed the lowest low of this particular momentum module. But this happened to be on a Friday, and we hadn't completed the break to the upside just yet, but take my word for it, this was in fact the lowest low. So we've got wave 1 and wave 5, and now we're going to work our way towards the middle. Now, starting up here, this could be wave 2, but it's also quite probable, in fact, that this is wave 2. And remember, as a general rule, you're going to have a simpler corrective wave and a slightly more complex corrective wave. So right now, there's a good chance, I believe, that we've got an A, B, C, and there's our wave 2. And notice that each one of these subwaves has its own little momentum module created by the red parabolic. At the other end, here's our wave 5, and so the first zigzag is perhaps wave 4. Obviously, we don't know for sure if this is going to be the final count, but this is where we're going to start from. So if this is the same, we haven't changed anything. We've got 1 and then an ABC for wave 2. We put wave 4 here because that's, gives us a logical way to start. If this is 4, then this would be 3, and we can see that there are some obviously carved out subwaves here thanks to these red parabolic modules. So it's possible that we could have 1, 2, 3, 4, 5 for wave 3, and that means we have a very super extended wave 1, which is okay. Wave 1 can be the extended wave, but here's what we got to determine. Is wave 3 bigger than one of these? Remember, wave 3 cannot be the shortest motive wave, and that is a rule that applies not only to the primary pattern, but to subwaves as well. And it's obviously shorter than wave 1, but is it also shorter than wave 5? If it is, this can't be the count. Well, let's take a look. All right, this green arrow measures the length of wave 1. It's clearly the biggest. We can eyeball that. This green arrow shows the length of wave 5, but this yellow arrow is our wave 3. And it is not bigger than either of these. It is therefore the smallest of the motive waves, and thus this count cannot be correct. So I'm fairly certain that our 1 and 2 are probably okay. Wave 5 is obviously the bottom. So what we're going to have to do is move these two up further and give this another try. So if we move 3 and 4 to this position, now we have something that looks a little better. Notice we have two potential extended motive waves. Wave 3, 1, 2, 3, 4, 5. These corrections were not strong enough to flip the red parabolic. We did have that down here in wave 5, however. 1, 2, 3, 4, 5. Well, we've maintained the guideline of alternation. We have a simple 3-4 zigzag and a more complex wave 2. And we have two potentially extended motive waves, which is okay. But now we've got to run the test again. Is wave 3 in each of these not the shortest wave? We've got to make sure that that's the case. So once again, we measure them. And here, the yellow, again, represents wave 3. And our wave 3 of the extended wave 3 is not bigger than 1, but it's definitely bigger than 5. So we're okay there. And in our extended wave 5, wave 3 is actually bigger than both 1 and 5. So far so good. It looks like this is a viable Elliott wave pattern. Here is the regression channel test. We start drawing it from the highest high. That marks the beginning point of the pattern, and we draw it down to the lowest low, our wave 5. Now, it's to be expected that you're going to have some minor excursions above and below the channel. That's always the case. But you can clearly see that well over 90%, probably closer to 99%, of the total pattern is contained within the channel lines. And also, when the price breaks out of the channel down here after our wave 5, it never goes back inside, and it keeps on going. So this also supports the notion that this is a viable pattern. All right, let's take a look at the idea of the ratio relationships. This is a Fibonacci grid, and this is another from the suite of drawing tools that NinjaTrader provides. And this blue line right here divides this total area into 61.8 and 38.2. And as you can see, wave 3 comes a little bit below that. And then wave 2 of our extended wave 5 comes right up and kind of bumps its head on that 61.8% area as well. And so we have a pretty good 62 38% dividing here of the total pattern. So based on all of the above, I would say that our Elliott wave pattern is definitely viable. It does not break any rules. It does not violate any guidelines. Is it the absolute only one that might work? Well, I don't know. If we really struggled here and played around, we might find another version that works. But Mr. Prechter says that if you got a situation where you got two possibilities, look for the one that satisfies the most number of guidelines. Obviously, any viable pattern cannot break any of the rules, but if you've got that, next look to see how many of the guidelines are satisfied. So I think this is a pretty good one, and this is a good example of how to approach the task of divining the wave count for any pattern that you encounter. As I say, you're probably going to want to start doing this after the fact. It's very dangerous to kind of do this on the fly until you've got a little experience under your belt. But eventually, as the pattern is forming, you're going to start being able to kind of see it in your head. And from my own experience, I know that one of the biggest problem areas that all traders tend to have is we tend to underestimate the size of some of these waves, particularly the corrective waves. Now, let's talk about something we could refer to as the damage control mindset. To err is human, and we are all human. That, of course, means that we're going to take some bad trades sometimes. But don't panic. Now, you've all heard the old saying, let profits run, cut losses short. And what I'm going to say to you here kind of runs afoul of the cut losses short part of that old saying. But the fact of the matter is that sometimes you can snatch victory from the jaws of defeat, and Elliott Wave can be very instrumental in helping that to happen. So what I'm saying is, when it appears you're in a bad trade, don't just panic and bail out. That's a great recipe to nickel and dime yourself to death in no time flat. Don't panic, and instead understand that you might be able to fully recover from many mistakes, or at least minimize their negative effect if you stay calm and remember this cosmic truth of trading. The market is constantly oscillating up and down on all time frames. Now, is there anyone who spent any time at all looking at price charts who seriously disputes that statement? That's what markets do. Markets trend, but they are constantly moving and they're constantly oscillating up and down. And this happens on all time frames all the time. Now, I've heard it said by some that, well, the market can move in three directions, up, down, and sideways. That is incorrect. The market can only move up and down. And if you find a chart where the apparent movement is sideways, I guarantee you that if you reduce it down to a small enough time frame, you will see that what appears to be sideways movement is really still an up and down oscillation. It's just happening in a very narrow range. So the point is that if you want the market to go in a particular direction and it goes in the opposite direction, it may come back. It may come back in your direction. And so what you need to do is to analyze the chances that that might happen. Now, often we attempt to enter a trade in the direction of the trend after a corrective bounce or pullback. Now, that's one of the reasons why it's so important to be particularly familiar with the corrective wave patterns in Elliott Wave, because it's the with the trend impulse waves that we want to trade. But when do we get in the trade? Well, usually after a corrective bounce or pullback. Well, the problem is that frequently we can find that we've jumped the gun. The corrective move was not quite finished yet. It had one more loop or zigzag to go, and it begins to move against the direction of our trend. But here's what you need to remember. If you hold on, the correction may eventually give way to the trend, because corrections tend to break out in the same direction that led into them. Now, this little graphic that I chose from Microsoft Clipart is not really directly related to Elliott Wave, but it kind of gives us a little five-wave pattern here. You got 1, 2, 3, 4, 5. Now, let's say you get in a long trade and you get in near the end of wave 1. Of course, you don't know it's the end. All you know is that your technical signals are telling you that there's a good probability that the market is going to go up, and so you get in the trade about here. Well, as will frequently happen, the market will go a little bit in your favor, but then all of a sudden it starts to tank. Well, some people will say, well, it's going the wrong way, let's bail out. Okay, you've just taken a loss. But if you know something about Elliott Wave, and you know a little bit about what preceded this particular pattern, then you might realize that, you know what, this is probably wave 1, and this drop is probably wave 2. If I'm right, then there's going to be a wave 3 that is probably going to make this long trade profitable. And sure enough, that's what happens. Now, you have to sweat through this, and you have to be able to handle it, but you can oftentimes snatch victory from the jaws of defeat if you know the nature of your mistake. Not all mistakes are the same. There's going to be times when, yeah, you're right. The only thing we can do is to get out of this trade or possibly even reverse directions. But there's going to be situations like the one I just described where the market is eventually going to go in your favor. And if you can handle it and stay in it and ride it out, you can pull a victory out of this potential loss. So having a basic knowledge of Elliott wave theory, especially the corrective waves, can definitely improve your win percentage by helping you know when to hold them and know when to fold them, with my apologies to Kenny Rogers. Now I'm going to show you some actual real-world examples of what I'm talking about. Now, these are screen captures of my personal trading from the past week, the week of our 4th of July holiday. This is Monday, June the 30th, and we had 1, 2, 3, 4, 5 trades, and I trade a 9-contract, 3-target peeling off strategy using the automated trade management functions of NinjaTrader, including auto break even and auto trail, and the score is net of the $6 per contract transaction cost that I bear in my corporate CTA account here. And so you can see $2,070. But what I wanted to show you was there's a couple examples of trades that were dictated by the technical signals, but I had to sweat through a corrective wave before they became profitable. One occurred right here. The market appeared to break to the upside, and it did, but then it immediately sold off and bounced off the trend definer, putting me in the hole. But I concluded that there was probably some type of correction here. I thought it was probably a wave 3, wave 4, going up to wave 5. And by hanging on, I was able to recover and hit the target. Over here on this side, I concluded that this was also perhaps a wave 5 conclusion of a bullish impulse pattern, which meant that this drop was either a wave 1 or a wave A. I got into it after we crossed the big parabolic after dropping below the trend definer, and it wasn't quite quick enough to hit the first target. So the market took a little corrective bounce, put me in the hole, but I figured the odds favored this thing turning around and selling off again, so I held the position and it became profitable. Now, here's the same chart with the Elliott wave count. Here's where that first trade was. I got long right here, and it immediately went south on me, but I hung in there and hit the target. Over here, I got short about here, missed the first target, had to sweat through this, but I wasn't sweating all that bad because I knew that the odds favored another sell-off. It didn't matter really whether this was 1 or A, because if it was 1, there would be 2, and then there would be 3, and the market would probably keep on going. If it was A, there would be a B, and there had to be a C. So I knew that there would be some type of pattern that would take the market lower and make my trade profitable, but I had to wait it out. And so thanks to my knowledge of Elliott wave, I managed to get a pretty decent score that I might not have had otherwise. Now, here is, this is Tuesday, July the 1st, and here's another late entry. The technical signals indicated this thing was breaking to a new high, so I got in right here, and I eventually determined that I had gotten in at essentially the end of wave 1. And in fact, this is almost the exact example that I showed you with that little graphic. I got in at the end of wave 1, had to sweat through 2, and then finally took off for wave 3 and ended up hitting 2 targets. Total score this day, $1,175.50. Let's look at the Elliott wave version of this chart. This is what I ultimately concluded was the wave count for this day. Right here is about where I got in. I wasn't sure of the wave count at this point. I went up, again, almost hit my first target, but not quite. Sweated through wave 2, and eventually wave 3 made the trade profitable. So again, a little knowledge of Elliott wave theory helped me have the fortitude to stay in that trade. Now, I don't know how often this kind of thing happens to you, but it does happen to me, and I've spent a lot of years, studying Elliott wave, and I still get fooled sometimes. I jump the gun, or I get in late, and then I have to pay the cost in terms of anxiety while I'm waiting for the trade to resolve itself. But I'm able to, thanks to that knowledge. Now, we must take the bitter with the sweet. So let me show you an example where my technique did not work. I thought at the time that this market was going to go lower. I thought that this was probably the end of a wave 3, and because wave 3 tends to be the motive wave that is most frequently extended, I expected it to go lower. It did not. But then I thought, well, if this is wave 3 and I can sweat through wave 4, eventually there will be a wave 5, and this might become a profitable trade. Well, it turned out that wave 4 was particularly complex, and wave 5 did go lower, but it missed my target by 1 tick. So on this particular occasion, I actually had a losing day. I lost $199.50. And here's what the Elliott wave count looked like in my estimation. A lot more going on here, a lot of subwave activity. The previous day looked like it ended on a wave 5, and of course we know that when we have a wave 5, there's going to be either 1 or A. And this looked like, couldn't really tell, this was 1 or A, and then we had sort of a 3-wave correction here, A, B, C. We still don't know if this is 1 and this is 2. I didn't conclude that this was C until the market started to go lower after this. And eventually it looked to me like we were going to have a bearish impulse pattern of some sort. Here's where I got short on what was ultimately wave 5 of wave 3. And it just moved like 1 tick in my favor, and then it stopped and turned around. And I saw wave A, B, C, and I figured, okay, well, now it's going to sell off and make my trade profitable. But this is one of the kind of rarer types of 5-wave corrections. This is the triangle type, where we have swings that get successively smaller. So it looked like a 5-wave wave 4, and it was viable. It's not retracing more than 100% of wave 3. And then here's wave 5. It got further in my favor, but it still was 1 tick too short. So after waiting all that time, I ended up with a loser. But you know what? That's going to happen because we're all human. And let's see. Here is, I guess this is Thursday the 3rd. And again, I got kind of a late entry on this long. The signals were there. My volume was rising. My 2 speeds of MACD were giving a bullish crossover, and we pushed the upper Donchian channel higher. So I got long, but the market did not go sufficiently to follow through. Actually, we hit the first target on this very quick trade. There was a quick pullback, and then the market went up again. And I'm thinking that I think this was, my conclusion was this was wave 3 and this was wave 4. And so wave 5 was eventually going to make the trade profitable, but unfortunately not on this swing. So I was in this long trade for quite a while, as you can see. And here's the wave count that I came up with here. We began this pattern the day before with a 1 and 2. And then these appeared to be the subwaves of wave 3. And this was actually possibly a truncated wave 5 of 3, because I think this was one tick lower than this wave 3 in the corner here. So this was 3. I had to sweat through 4, and then I had to wait until wave 5 got high enough to turn the trade profitable. But eventually I hit 2 targets, and the trade definitely worked. Now, I do an Elliott wave count every single day, and I use the day session only chart because all major cycle theories were developed prior to the advent of 24-hour trading. And so what I have found is that when you have a distinct, well-established Elliott wave pattern concluding on one day, it gives you a leg up on what's likely to happen the next day. So I suggest that just looking at my Elliott wave charts on a daily basis is something that might help you absorb a little more knowledge about Elliott wave. And I'm going to show you how you can get my daily email update free of charge here in just a moment. And as I say, each one contains an Elliott wave chart along with my personal charts and also typically my trading room charts on Tuesdays and Thursdays. Here is the daily email update from July 1st, I believe. That was Tuesday. That was the first trading room day of July. And as you can see here, fellow traders, our first trading room day of July 2014 was a profitable one. We ended at 12 noon with a net profit of $879.50. Then I took another short and brought our score into grand a day territory. More about grand a day in a moment. After my entry on that last trade, the market touched my first target several times without filling it, then took a corrective bounce to the trend definer. I surmised that the bounce was probably a wave 4, which meant there would be a wave 5 that might turn the trade profitable. So I held on and eventually hit 2 targets. Just another example of how some basic EWT knowledge can fortify one's damage control mindset. I also hit my grand a day goal in my personal account, and I have attached my EW account for today. Summer's off to a great start. Have a pleasant evening. See you all back in the trading room on Thursday. Now you can see I've got 2 trading room charts attached. I've got my personal chart attached, and I've got my EW count attached. So if you want to get on the mailing list to see these, all you got to do is give me the information I'm going to request in just a moment. Now let's talk quickly about GADGET, which is an acronym for Grand Day Group of E-mini Traders. I make no guarantees, but my personal goals are these: to help every student become a competent and confident trader with a win percentage of 90% or better, to help most students earn enough to pay for the course within 3 months, to help some students earn $1,000 per day or more within 1 year, and to help a few students earn $1 million within 5 years. I am serious. Are you interested? If you are, this link will take you to this page on the Pacific Trading Academy website, which you can go to by hitting Enrollment and Mike Bridges Mentoring Course and Trading Room. This will tell you all about it. This will give you information about the price and payment plan. And this is the page where you fill out your information and actually enroll. You get 3 months access to video lessons produced by me. You get 12 one-on-one phone conferences with me, and you get 3 months of access to my twice-a-week Tuesday, Thursday live trading room. If you decide after the course is over that you want to stay in the trading room, there's also optional month-to-month extension. That month-to-month is also available to Pacific Trading Academy graduates, not just my students, but graduates from any of the mentors at PTA. Now, is grand a day a realistic goal? A very good question. Let's look again at my personal trading from last week. 2,070 on Monday, 1,175.50 on Tuesday, dropped a little bit on Wednesday, 199.50, and Thursday, of course, was a short day, ended early, but made 479.50. This is what those scores added up to in that short week prior to the holiday weekend. I averaged 881.37, which is obviously short of $1,000, but I did better than $1,000 on 2 of the 4 days. So yes, it is doable that you can make $1,000 a day in the S&P E-mini. Now, let's talk about the special offers for today's attendees. Now, by the way, if you're later seeing this on the video, there's some of this that's still going to be available for you. Now, the first thing, however, is that you can enter our raffle to win 1 free month in my twice-a-week live trading room. I'm going to show you how to do that in just a second. Now, the raffle is going to be this Friday, July the 11th. So if you're watching this on video after that date, that offer's no more, not good anymore. But the other 2 definitely are. You can still ask for these freebies, even if you're seeing it on video as opposed to attending live today. You can also request a copy of my EW Delta Combo NinjaTrader chart template, the same one that I use every day. And you may request inclusion on my emailing list to receive my daily email updates showing my personal trading and daily EW count. Here's how you register for the raffle. Go to pacifictradingacademy.com/raffle, R-A-F-F-L-E, / again. So pacifictrading.com/raffle. Fill it out, and we'll let you know if you win. So, if you have questions or comments, if you'd like to be added to my email list, or you'd like to get your copy of the NinjaTrader chart template, contact me at mentormike@charter.net, and please include your phone number and time zone, or better yet, sign up and become my student. Now, let me leave you with this. There's something called the Pareto principle. You may know it better as the 80-20 rule, or the law of the vital few. It basically says that in practically any area of life, 80% of the effects are brought about by 20% of the causes. In trading, it's been my experience that 20% of traders make money and 80% lose money. If you are in the 20%, if you believe yourself to be, then take action. Invest in yourself and come and work with me. That is pretty much what I can tell you. Let's see. I've got 2 questions here. I think that's all we have. Is there more? Yeah, that's about it. Let me see if I can answer them very quickly. Marcus asks, hello, Michael. When was your first introduction to EWT? How long did it take you to profit from your knowledge of it? Well, it took me a while. I've been working at this for probably about 10 years. But I'd say I was starting to make use of it within the first year. One of the things you have to be careful of is don't try to do it on the fly until you're really confident with your counting ability, because what happens is you'll tend to fall in love with your prediction, and then it becomes very hard to change your subconscious mind, and you'll actually miss signals that are in opposition to your prediction, even when it's clear that it's not going to happen. Sal suggests if you wish cleaner charts for E-wave counting, you should try Tick Volume or Renko. Well, you know, we all see things a little bit different, and if that works for you, Sal, more power to you. I'm quite comfortable with the technique that I have, but there's many ways to get to the same place. So thank you for that tip. That's it, folks. I'm going to turn this back over to our host, Wesley, with my thanks for being allowed to present to you today. Wesley, are you there? Take over, please.
All right, and a special thank you again to Mentor Mike Bridges of Pacific Trading Academy for that great presentation. NinjaTrader Ecosystem is pleased to sponsor these weekly partner events as a value-added service for all of you clients. So if you do find value in these events, we hope you will attend them on a regular basis. You may all stay logged into the room for the NinjaTrader Charting Level 1 and Chart Trader event that will begin at 12 noon Eastern today. Again, we do appreciate the time you spend with us. Enjoy the rest of your day, and we hope to see you in future webinars. Happy trading from all of us here at NinjaTrader Ecosystem.